Woo, woo, woo. Yeah. What can I say? Another great week here for you Wall Street winners. And happy Memorial Day. And in honor of Memorial Day, which is, of course, the official beginning of the summer driving season and barbecue season, I'm renaming this publication Wall Street Wieners. Let's cook up some hot trades, shall we? All right, let's go. First of all, S&P staggering sideways. Purple predictor still bullish. It's way above where the price action is, but the price action's just not going very much. Everything else is pretty much bullish. You'll see as we go along here, but the price action needs to start breaking up here. Now, let's take a look here. Last week, we highlighted how the DI plus, the green line, was above the red line, but look at what happened. They're now on top of each other. They're basically unchanged. And so this thing here, we've been in this now sideways trading range for February, March, April, and now basically all the way through May, 4 straight months of sideways price action. You know what that means? We're about to break out. Now, maybe this can go another month sideways. That can happen. But periods of low volatility are followed by periods of high volatility. Periods of no trend are followed by periods of high trend. But you know what? Who cares? We've got great stocks in our portfolio. We're making money, I think, on every stock but one in our portfolio right now. We'll talk about that one when we get to the fully paid up members. But the point is that it's still a market of stocks. So some stocks are going up, some stocks are going down. The overall market may be going sideways, but who cares? All right, NASDAQ looking a little bit perky here. We made a new high close on the move. Purple predictor bullish. Seasonality bullish. The red line is where I would turn to neutral. But look at the purple. The price action sold off a little bit, but the purple predictor went to a new all-time high, suggesting that IWM, small cap stocks, are going to continue to be the leader in this market. And of course, if you look at our portfolio for the fully paid up members, it's nearly all mid-cap stocks, which are doing much better than the large cap stocks. Seasonality, we've gone over this before. All right, yield curve, we've gone over this before, so no need to waste a lot of time here. Now, this was interesting because the asset allocation shifted. Now, it shifted, you see, at the end of middle of April into the beginning of May. So this is no big deal. It goes up and it goes down. It's still a bull market in asset allocation, meaning that money is coming out of the bond market and into the stock market. So people are always saying, well, how can this bull market continue? How can it go up? Well, take money out of bonds and buy stocks. That's how it goes up. Now, this was interesting. Over the last month, we've seen the stock market risk indicator here go to all-time highs. This thing is screaming. You can see it's the strongest it's been for the last year. I mean, and by the way, if you went back further, it's the strongest it's been for quite some time. And what this indicator measures, this is one of my super tricky indicators, unique to me. Nobody else has it. And what it's saying is that people and stock market investors want risky assets. They don't want safe havens. And when people are feeling frisky, i.e. risky, then that is bullish for the stock market because it means they start to chase stocks. They start to lift offers rather than wait for their bids to be hit. So this aggression shows up in stronger price action. And yet the market's really just going sideways. So there's an underlying powerful thing going on here in the marketplace with our stock market risk indicator picking this up. So we got to keep, this is something that's on the top of my mind right now. Now, global shares finally broke out. Still just don't see any action there. Bonds, this is why the asset allocation turned around. Bonds started to skyrocket. Now, I've been quite bearish on bonds until recently, and then looking at the situation, I'm actually changing my mind entirely. So first of all, purple predictor has remained bullish, but let's take a look at our key indicators here. The green line is the 10-year Treasury, which is the inverse. Remember that interest rates go up if bonds go down and vice versa. Okay. So notice the gold line. That's the price of gold. That's going down. That suggests weaker inflation in the future. The chart itself is the CRB, and that is suggesting higher interest rates. But it's the blue line that's the key. The blue line is the biggest competitor to the U.S. It's the German 10-year treasuries, and it's plunging in yield, plunging in yield. Did I mention it was plunging in yield? It's down to 0.41%, whereas the U.S. is up about 2.25%. So that's starting to put a big downward pressure on the U.S. treasuries, on the treasury yields. So that's the key thing why I'm starting to get more and more bulled up on bonds, at least for the short term. I still think it's going to be a tremendous bear market down the road. But for the short run, I'm getting more bullish. Now, if we have, let's go back here. If U.S. interest rates are up around 227 and German yields are 0.41, where are you going to invest your money? Well, you're going to invest it in the dollar because you're going to get a 1.8% more money. Five times as much interest. So, of course, that's getting the dollar to get all pumped up. Now, let me make a dramatic call. And, of course, you're always going to get dramatic calls here on Wall Street Wieners. And that is that the dollar's rally is just about over. You should start seeing the dollar top out this week. So keep an eye out for that. The big rally that I called for, it's basically over. I'm just a little bit early here, but it's basically over. Big dramatic call of the week. Gold broke down. This chart's basically the same chart as last week, but we broke the purple line, which was heavy, heavy, heavy support. We've rallied back up. That's called a throwback or a pullback. But we've hit the intersection of the old support line and the downtrend line. This will not break. It's incredibly hard to break two of these lines where they coincide. So look for gold to move back down this week. Still don't want to get short, but I'd rather be short than long. But I'm just looking for this market to move lower over the near term. Our gold indicators, the top one is bearish. The middle one, kind of neutral. And the bottom one, you could say it's bearish from a long-term perspective, although it did rally quite sharply this week. But really, it's a dog's breakfast. We're not really seeing clarity here. So once again, rather stay away from gold. Now, energy plunged on news that Russia and OPEC have agreed to increase production. And furthermore, to increase production even more next year. So my bullish stance on oil and energy is over. We must be getting short these markets now. Because not only are Saudi Arabia and Russia going to increase production, we're going to see every country in the world increase production. But a big one is the U.S. is going to be increasing production this year by 1.4 million barrels a day. So look for oil to go back into the 50s, probably back into the 40s. I'm now looking for reasons to get short oil. Now, Bitcoin did exactly what we told you it would do, drift lower. And I think this week it's going to continue to drift lower, down to below 7,000. Now, at that point, we need to start to watch some things. Eventually, I'm looking for Bitcoin to get to 4,000. But that support there at around 6,450 is pretty strong support. And I would not expect to see Bitcoin break it the first time through, particularly since the purple predictor, which is colored blue on this chart, is quite bullish and shows that smart money, which bought heavily back in January, remains heavily invested in Bitcoin. So they're using dips to buy is what I'm really saying. So look for it to drift a little bit lower to below 7,000, and then look for a rebound back up to about 9,000 over the next 2 weeks. All right, everybody. Thanks very much. Love having you here. Most of these courses are done now. You missed them. Too bad. Could have made a lot of money, but there you go. Hey, everybody. Hey, freebies. We'll see you later. Fully paid up members. Just hang in there for a second.